So I can't recall very well. So let me just take, like, this should not take me 2 minutes just to refresh up. Pareto Limited is the holding company of a listed group of companies with its year ended 30th June 2021. Pareto Limited has made a number of acquisitions and disposals of an investment. The following summarized draft statement of financial position relates to the group companies for the year ended 30th June 2021. So we have Pareto, Pamba, and Dafu, as you can see. So the year is ending on 30th June 2021. 30th June 2021. So for the financial year to end on 30th June 2021, it must start on 1st July 2020. 1st July 2020. 1st July 2020. Let's go to note 1. On 1st October 2020, 1st October 2020, somewhere here, 1st October 2020, Pareto Limited acquired 80% interest in Pamba. So Pamba was acquired. Pamba was acquired. Let me mute noisemakers. Those who have not muted themselves to avoid interruptions. So Pamba was acquired on that date when its retained earnings stood at 35. The purchase consideration comprised 1250 million of Pareto Limited shares with a nominal value of shillings 1 each and a market price of 6.8 million each. At acquisition of Pamba Limited, the only adjustments required to the identifiable net assets of Pamba was for land, which had a carrying amount of 625, less than its fair value. That is the valuation. Okay. The group's policy is to measure the non-controlling interest at fair value at the date of acquisition of Pamba Limited. The non-controlling interest at a fair value of 21.25. Pareto Limited had acquired 100% equity interest in Dafu Limited a number of years ago when its retained earnings amounted to 1750 million. So Dafu was acquired long time ago, and the parent had acquired 100% shareholdings, 100% shareholdings. Okay. At acquisition, the fair value of the identifiable net assets of Dafu approximated their carrying values. So when the carrying value approximates fair value, it means there is no revaluation. The purchase consideration comprised cash amounting to 5750. Pareto Limited disposed of 60% of its investment in Dafu. 60% they disposed of. Now that is the key issue here. Pareto disposed of 60% of investment in Dafu on 1st April 2021. So 1st April is here. 1st April 2021. Dafu disposed. Dafu was disposed. Dafu was disposed. The fair value of the remaining 40% equity interest was 43. Number 5. None of the companies had issued any shares since Pareto Limited acquired its shareholdings in them. Neither the goodwill on acquisition of subsidiary nor the investment in associate have been impaired. So there is no impairment loss. So on the analysis very fast, Pamba, during consolidation, we shall consolidate for Pareto, P&L, profit and loss. I don't want to see then what we have been required to do. Profit and loss will be Pareto in full plus Pamba, but Pamba was acquired here. So you will account from this date from here to here. How many months are those? So how many months are those? You check, we had something we have said even, or you can recheck. How many months were they? They were 9 months. So Pamba, 9 months, plus Dafu. Dafu, you will check. You know, Dafu was disposed here. In which case we were having 100%, then they disposed 60. So when they dispose 60, it means we are remaining with 40. 40 is an associate. Associates, we don't consolidate for them. So we only consolidate for DAFU for the period it was a subsidiary. And it was a subsidiary from here up to here. From this period, it became an associate. So from here to here, also we counted and we got how many months? How many months were those? For monthly 9. So 9 over 12 from here to here. It means DAFU was 9 months subsidiary, 3 months associates. Correct. Then when we go to the balance sheet, you will take Pareto in full plus Pamba. By the time we're closing the year, Pamba was already a subsidiary. So you take Pamba. But Pareto, at the end of the year, 40% it was an associate. Associates, we don't consolidate for them. So we only take Pareto and Pamba in the balance sheet. Here then, that is the procedure. So I think the analysis is good. Just in case someone was not there, please master that chap in the books so that we kick off from where we were supposed to start for everyone. Good. So let's go now to required Roman 1. Let's go to required Roman 1. Required Roman 1, they want us to calculate goodwill arising on acquisition of the investment in subsidiaries. So the two of them. So come here and say A, goodwill on acquisition. Goodwill on acquisition. So on acquisition, on acquisition, on acquisition, on acquisition, on acquisition, we shall consider Pamba and DAF. So Pamba Good. So let's take purchase consideration for each. Purchase consideration. So purchase consideration, we can pick them from the balance sheet under investments to avoid lots of time wastage. So check under non-current assets. Check under non-current assets. So under non-current assets, you can see investment in Pamba was 85. This one was 57, 50. 57, 50. Correct? Then fair value of non-controlling interests. Fair value of NCI. Fair value of NCI was mentioned in which note? Note number 2. Check note 2. Note 2, the group policy is to mention non-controlling interest at fair value. At the date of acquisition of Pamba, the non-controlling interest had a fair value of 21.25. Huku kwingine ni kama hakuna kitu kama hiyo. Unless you are seeing fair value of NCI, there was nothing like that. So, hata kukuwa na NCI, at the date of acquisition of Dabu, there is no NCI because parent acquired 100%. 100% means parent is controlling everything. There is no minority. So that is why we don't have fair value of NCI on the other side. So this is 21, 25. They don't have because that is 100%. So we have this. This will be 10, 6, 25. 10, 6, 25. This is 57, 50. Then you call it A. You call it A. Good. Less net assets. Less net assets acquired. Net assets acquired. Ordinary share premium retained earnings and revaluation. So ordinary share capital, go to the balance sheet. Ordinary share capital, go to the balance sheet. Nataka goodwill mkiulizwa msitoke bure. I'll show you how they mark it. I'll tell you how it is marked. So ordinary share capital 25 to share premium 1.5 retained earnings. So retained earnings go for the date of acquisition. So check note 1. On 1st October, Pareto acquired that when the retained earnings was 35. So this was 35. For Dafu, we have to go to note 3. You will see the retained earnings was 1750. Check additional information number 3. You will see 1750. 1750. Correct? Then there was this note, paragraph 2 of note 1. paragraph 2 of note 1, they said at acquisition of Pamba, the only adjustment required to the identifiable net assets of Pamba was for land, which had a carrying amount of 625 million less than its fair value. That is revaluation, but maybe I've been using the word revaluation so many times. I'm afraid there is something you can see somewhere, then you get confused, but it still stands for revaluation. Fair value uplift. So there is what we call fair value uplift for land. So that is the revaluation itself. So when you see somewhere them talking of fair value uplift, that is more or less of revaluation. It was here 625, nothing this side. Here they said they were equal. So can you add? Then call it B. So tell me, Pamba, Dafu, how much? Give me those figures. So I've gotten figures. People telling me Pamba 76.25, 76.25, Dafu 42.50, 42.50. Therefore, goodwill, there was no impairment. So you take A minus B. That is our goodwill. So I want the goodwill figures. So good. In 24 kweli. Masi hebu angalia hiyo ya nini vizuri. Ya Pamba. Yeah, it should be 3. Sio ni kidogo sana. So this is 3. This is 15. So that one will earn you 4 marks from what I've seen there. You give her 4 marks. So maybe someone has been tested on how the 4 marks should be achieved. But just like find the one that you're going to go very mean. And sometimes it is good for me to be very honest with you. This at this level, this is how they will mark to get the 4 marks. It is 1, 2, 3, 4, 5. Pivot. Any 2 at 2, 4. Where I've put the tick. In section 3, you will find them marking these ones. You will find them marking this ordinary share premium. But here, Mostly they just want the total of the net assets. Then purchase consideration, that is very key. Fair value, that is key. So it is just purchase considerations, fair value, total of the total, not individual, total of net assets. Then any 2 times 2. So that one is something you need to get. Simply by getting this one and this one, only you get the formats. So those are our goodwills, unless someone has an issue. No, before I forget, I'm tasking someone here after the class for what you said. Who has a question on what we have done? Who has a question before we proceed to the next required? Good. It seems there is no question. It seems there is no question. So let's go to required B. And I hope if I delete, there is no problem. So required B. So let's go to B. So B, the individual, gain or loss arising on disposal in the DAF limited. So gain or loss arising on disposal of the investment in DAFU as reported one in the individual financial statements of Pareto, then in the consolidated statement of profit or loss. So, you know, Pareto is the parent. They had acquired 100% in that other company. So they are selling off this company 60%. So in the individual books, before they consider it as a group, what is the gain or loss? Then when it is taken to the group now, the consolidated, what should we report? So B, right here, B Roman 1, gain or loss on disposal of DAFU, in the individual financial statements of Pareto. So in the individual books means no consolidation. Means no consolidation at all. Means no consolidation at all. So how that? And for my self-assessment, also I would want you to tell me what I'm doing because I'm trying to. The way I've adjusted the online compared with the last, is there a good improvement? Or I should continue doing something? You know, it's modifications I'm trying to do so that you get the best quality. Compared with, initially I was using laptop, so here in my later desktop, is there some change? I didn't say this one is now very good. Sound is very clear now. Okay, this is better. Thank you, thank you. So in case of anything, so that I can see what to do. Now I know I've done something good. So in the individual gain or loss on disposal of DAFU, in the individual financial statements. in the individual financial statements. So the individual financial statements means there is no consolidation at all. No consolidation at all. So what you do, you write here shillings in millions. Shillings in millions. So you say disposal proceeds. Disposal proceed. Disposal proceed. So disposal proceeds, that is the amount we sold the subsidiary, iliuzwa pesa ngapi. So go to note number 4 and tell me how much did we dispose the subsidiary. How much did we dispose of our subsidiary? How much? How much? Everyone says 47. So check note number 4, not note 3, maybe I've misled you. Note 4. Pareto disposed of 60% of investment on this for 4,700 million. So that is what we received. So bring here 47. Bring there 47. Then you less investment disposed. Investment disposed. I want you to master how it is done. So let's go procedurally. To use that disposal process, to know whether you have gained or have lost, you just check what you received vis-a-vis what you have sold. So we sold it at 47. How much? What was our investment? What was our investment in DAFU? Tell me, how much did we invest in DAFU? In DAFU, we had invested, Mercy, 57.50. Yeah, correct. That was the cost of investment. It was 57.50. So when we have sold it at 47. When we sold the investment, we have received 47. But the question will be, you have sold an investment of how much? So we've never sold the entire 57.50 because 57.50 is the total amount we invested. But we have just sold what percentage of that? What percentage did we dispose of? We disposed of 60%. So you'll come and say, we sold 60% of 57.50. So get 60 of this, that is what we are selling off. Then you compare. You know whether you gained or you lost. So 60% of 57.50. That one is likely to be how much? That is likely to be 34.50. So this is 34.50. So from your assessment, we lost or we gained? We gained because we have sold an investment with a value of 34.50 and we have received 47. So we are talking of a gain of how much, students? 12.50. Thank you. 12.50. And that one comfortably earns you 2 marks. Comfortably earns you the 2 marks. If there is no question, we go to Roman 2. Roman 2, the consolidated statement of profit or loss. So Roman 2, in the consolidated statement of P&L. Consolidated statement of P&L. Have that. That is Roman 2. So this is now in the group. Individual, hakunanga mambo mingi ya consolidation. You go straight. So, can you peruse back kidogo? Check check how we did it before. No, the format I gave you. Check the format I gave you. Good, you have checked. So now, this is how you go about it. You start again with this. So you will say, disposal proceeds 47. We received 47. Then now, here, you add fair value of what we call the retained interest. So fair value of retained interest, whatever they are holding back, you add it. It's like an income, but not that direct. So retained interest, just a minute. So fair value of the retained interest, just check where it disposal. So in that note 4, they said Pareto disposed of 60% of that for this when the fair value of the identified net assets was that. Please underline for me that 6250. It is just coming up shortly. It was 6250. When they were disposing, their net assets had a fair value of 6250. The fair value of the remaining 40% equity interest is 43. So you add whatever is remaining, we are remaining with 43 plus what we have received. Is like that is what you have invested in that company. So you take 47 plus 43. So the total will be 9,000. Then for consolidation, you will less net interest, of net interest disposed, net interest disposed. So the 6250, they said that they disposed it for 47 when the fair value of the identifiable net assets of DAFU was 6250. So bring it here, 6250. They were disposed when our net interest in that company was standing at 6250. And then again, goodwill on that date. We are also selling off our goodwill. So you will less goodwill disposed. Goodwill disposed 1,500. I remember goodwill in DAFU. DAFU was having a goodwill of 15. So the goodwill was 15. Net interest on that date, all the net assets on that date was 6250. So the total is going to be 7750. It's going to be 7750. Therefore, this was again, this one is also again, how much? Mostly, though not always, nakwanga the same. 1250, yes. 1250. That is another 2 marks. So any two at one. Any two at one is 1, 2, 3, 4. So any two at one. As simple as that. I want to jump to the balance sheet unless someone has a question. Come up on swali, please ask before we go to the balance sheet. But as I wait, before we go to the balance sheet, I know there are 3 workings which are not going to give us peace. 3. 1, remember, DAFU became an associate. In the balance sheet, associate appears once, investment in associate. So we need to get that investment. That is 1. 2, retained earnings, as usual. Retained earnings and non-controlling interest, those 3. So because we are not time barred, I don't see why we should start them have stops on the way. Let's do those 3 workings, then we just remain with presentation. And be very keen, more so on non-controlling interest and investment in associates. In some questions, I've seen them being part of required. So you need to know, how do you calculate investment in associates? That one is something you really need to be careful about. So it's simple. Simple. So I want us to call it working 1. I want us to call it working 1. Investment in associates. Investment in associates. So investment in associates, in our are very simple. What was, check here for our understanding. DAFU is the one which became an associate. Initially, parent was having 100%. Then they disposed 60% somewhere here, remaining now 40%. So it was an associate for only 3 months. So you need to check how much did we invest? How much did we invest in the associates? So investment in associate is the fair value of our investment which remained, what we returned on the date of disposal. What we returned back, the investment which we returned back, that is what we assume to have invested. Like they say in check note 4, the fair value of the remaining 40% equity interest was 43 in note 4, if you check note 4. So that is what, in quotes, that is what we invested in that associate. So you come here and say, fair value of 40% at disposal. Fair value of 40% at disposal. It was 4,300. It was 4,300. Then, in associated, you just check how much profit did they make after acquisition. So after acquisition means after it became an associate. So from here to here. That is what you need to consider. So on the date of disposal, actually here we have to be very keen. You don't go to just a minute and analyze something. Okay. Okay. I've seen, and it is my prayer that you will understand this. Now, you need to add what we call post-acquisition profits. Come and say post-acquisition profits. Post-acquisition profit. That is the only element which you need to top up. That is the only element you need to top up. But now, the way this question has been arranged, it might be really confusing because, what should happen? Check close of the year. At the close of the year, retained earnings, you are seeing 5750. That is in the balance sheet. Check retained earnings of DAF in the balance sheet. You will see 5750. So post means after it became an associate, so I want from here to here. So the examiner, when you check on this date, check that date, check on that date in note 4. Pareto disposed of 60% of this on that for 47, when the fair value of the identifiable net assets was 6250. The fair value of the remaining. So they gave us fair value of net assets. Net assets is what they gave. But back in our mind, we know that the net assets here comprises of ordinary share capital, share premium, retained earnings, and what have you. But whatever we want the retained earnings. So with them, on this date, they are giving us the total retained earnings, the total net assets. On the date of disposal, they are saying the total net assets is 6250, the total of this. So it means at the end of the year, what we can do, because 5750 is only retained earnings, we can take the total net assets. So check the balance sheet of DAFU. The total net assets is 8250. So when we talk of net assets, we are talking of these three. Mark you, and you know this we have been saying, ordinary and share premium, they remain constant. What keeps on changing is retained earnings. That is what is brought down carried forward. These ones are constant. So we tend to assume that the net assets which the ordinary and share premium which were there here on this date are the same value which are still here. So the increase between here and here is just the retained earnings. That is what you need to know, and that is the profit. Profit is what makes the net assets to keep on changing the equity. Equity normally increases with retained earnings or drawings. Drawings, those are non-issues to us here. So profit is what will uplift the equity. So for them to say on this date, net assets was 62, and at the end, net assets is 82, the increase from here to here is assumed to be the profit. And that is something you need to know. Ordinary and share premium, constant. So if an examiner fails to tell you the profits, but is giving you two net assets, just get the difference between those two net assets. The difference between the net assets is the profit itself. So you'll come here and say it is 82. So post-acquisition profit of net assets. So net assets will be 40% of 8250 minus 6250. Give you that figure. As simple as that. 800. So it means in associates, the investment in associates which will go to the balance sheet is 5,100. When you have two net assets, closing and your ingine, difference no longer profits because net assets is those ordinary share, those ones will not change, they are constant. So the change in net assets is the profit itself. That is what you need to know. So the investment there should be 51. Let's go to working 2 and 3, then we do presentation. So working 2, non-controlling interest. I want us to check the equity of these noisemakers. So equity is assessed at the end of the year. The end of the year, we'll only have NCI in Pamba. DAF became associates. So at the end of the year, they don't have any equity. If we're doing P&L, then I will prorate profit for the period it was a subsidiary. Balance sheet, we never prorate. So at the end of the year, we only consider NCI of Pamba. DAF became an associate. So we don't check their equity at the end of the year. So you will just come here and say, fair value of NCI, fair value of NCI at acquisition. At acquisition. So on acquisition of Pamba, what was the fair value of minority? So how much fair value of minority? $21.25, correct? Then with them, they will just take the post-acquisition profit. But in this question, I realized these people are talking of the net assets so much. So you say, and post-acquisition profit or net assets. I've seen them talking of net assets too much. Parent was having 80, so minority will take 20%. Ngoja nione what happened. Post-acquisition is just the closing minus at that time. Closing minus that time. So just give me a few minutes to check for you. Now here is profit will work. So check the closing retained earnings. Closing retained earnings, 5250. If you check the balance sheet, the profits, 5250. If they talk of the profit, then fine, just use it. If they fail, use the net assets. So 5250, the closing in the balance sheet, minus the profit on the date that subsidiary was acquired. Check note 1. When you keenly check note 1, you will see when it was acquired, the retained earnings was 3,500. So you take 5250 minus the 35. So the profit was clearly provided. If they don't provide and they give you the net assets, then work with the net assets. So give me the figure, but after you have taken 20% into consideration. $350, right? So it means minority will only claim how much? So let's go for the retained earnings. That is the last working. That's the last working. I want us to check retained earnings. I want to do it here. Yes. Small disruption there, fine. So retained earnings. Without knowing that they're disturbing people. So take for Pareto. Take the retained earnings at the end of the year for Pareto in the balance sheet. Go to the balance sheet. Pareto, I just want to check whether we are in the same page. How much are you seeing for Pareto? $78, 25. Yeah, that is correct. So this is 78, 25. Correct. Then for Pamba and Dafu, you will take what we call post-acquisition. That is what you must know there. So you will say, and post-acquisition profits. So post-acquisition profits in Pamba. So in Pamba is this one here. This one. You just take, no, this is Pamba. Yes, see Pamba. Yes, this is Pamba. Pamba, you just take 52.50 minus 35. But remember now, parent takes 80%. Minority, okay, the retained earnings which goes to consolidation, we normally go for the retained earnings of the parent company. Parents. So you take 80% of this one here. So Pamba, you will take 80%. Sorry. You take 80% in bracket 5250 minus 35. I want to see what you are getting. Yes, for Pamba. How much is that difference? You take 80%. $1,400. So we bring here 14. Then for DAFU, we shall have to be very careful. We shall have to be very careful. There's a student who I don't know what is the issue. Yes, Quinton? It's our simple class. Maybe. Yes. Sorry for that. So DAFU kuna maneno mbili which you need to be keen about. Check here. DAFU iko hivi. And DAFU, remember, they are talking of net assets mostly. Net asset at the end is 8250. 8250. Then on the date of disposal, 6250 here. And this portion here is an associate, which we take 40% of the difference from here to here. Then the difference from here to here, we need to take 100%, because parent was having 100 up to here. Wakauza 60, wakabaki na 40. So the difference from here to here should be 100. Here to here should be 40. And in this company, they are talking of net assets, net assets, net assets. So the favor I would really wish you do for me, check for me the net assets of DAFU on the date of acquisition. The examiner did not provide, but we got by adding those equity components. Check where we did goodwill, where we calculated goodwill, the total net assets on acquisition, somewhere here. It was how much? Check where we calculated goodwill. We did it for ourselves. The net asset, you know, in DAFU, instead of profit, they were talking of net assets, net assets, net assets everywhere. So check for me the net assets at the acquisition dates. Yes. Yes. Yes, Steve, can I call you back at around 9:30? So thank you so much. It was 4250. So what we are going to do, when you have net assets, I told you, net assets is the ordinary share capital, share premium, retained earnings. Ordinary and share premium are always constant. What keeps on changing is the profit. So the difference, this increase you are seeing here is just the profit. So between here, this space and this space, you will take, is that 100%? Yes, you take 100%. Then this space from here to here, you take 40%. So you come here and say, before disposal, you take 100% of 6250 minus 4250. That is 2000 from what I can see, 2000. Then after disposal, it will be 40% of 8250 minus 6250. This one even we got somewhere here. 800. We got it up here. Like that. Then one more thing, during disposal, we got a gain. Gain on disposal of DAFU. We gained how much? You have the figure. It was not required of one equal due. Those figures were coming to how much? Those figures were coming to how much? 1250. Thank you. We are done. So can you add for me the consolidated profits? Consolidated profits, someone? 13, Susan, someone to confirm, 13,275. A confirmation of the same. Confirmed. 13,275. Those are the only critical workings. Otherwise, hakuna kama iko ni kitu hivi tu, but those are the only workings. So now, in consolidation, we also agreed that DAFU became associate at the end. You know, balance sheet is prepared at the end of the year. We are not going to apportion assets and liabilities. So we are only going to take Pareto and Pamba only in the balance sheet. That is the consolidation. I think it's gonna be very easy. So right there, unless you have a question, without question, just write Pareto group. So right there, Pareto group. So it is all about Pareto and Pamba. I tend to believe you are ready, so we can start. Non-current assets. Non-current assets. So non-current assets, property, plant, and equipment. So don't proceed to the company which has been disposed. So this is 14,900 plus 9250. But there was revaluation of land. There was revaluation of land. Check additional information number 1, paragraph 2, 625. How much? Chapa hiyo tukisonga. Mercy 24,775. Susan 24,775. So 24,775. Good. Next. Investment in Pamba replaced with goodwill. So goodwill, there was no impairment. So how much was the goodwill on acquisition of Pamba? Check for me that figure. We got it up there. Kennedy, 3,000. Yeah, you have it, so I believe that's correct. So 3,000. Then investment in DAPU, now you bring what we call investment in associates. So you say investment in associates, working 1. So check your working 1 for investment in associates. What did we get? We got Susan 5,100, Randy 5,100. Then we have financial assets. Financial assets. Financial assets, we have 31 plus 28, giving us 59. So can you add for me the sum? Hata usiadd, don't add. Current assets. No, let's just add. Let's add the sum of non-current part, so that we be good people. Uh-huh. 38,775. Current assets. Current assets, there was no UPI. Maisha imekuwa mzuri huku. 3850 plus 4425. What do you get? 3850 plus 4425. Oh, I know something. Hold it, please. Hold it kidogo. Hold the 8275 kidogo. It is 3850 plus 4425. So the items, there is one item people normally forget. As well, maybe you're not moja wao. Check this one. On disposal, check for me note number 4. In note 4, they disposed the subsidiary. The amount at which the subsidiary was disposed for, that cash, you need to debit it here. So that is 8275. Then you top up. But I don't see examiner. I don't see a situation whereby the examiner will mark you wrong. If you first of all bring this, then, but now you see this cash book is part of current assets. So you just have to add it here, 47. So please indicate here, cash on disposal, for you to remember where it's coming from. Cash on disposal. So whenever we have disposal, the amount you have disposed the subsidiary you should bring it as part of here. So confirm how much? How much if you top up? 12,975. 12,975. So our total assets, how much? Brandy, someone to confirm. 51,750 confirm. 51,750. Equity and liabilities. Equity and liabilities. Ordinary share capital, parent only. Share premium, parent only. So, ordinary share capital, you only consider for the parents, that is 10. Share premium, also parents, 5. Retained earnings, check working 3. How much did we get? I deleted mine. Someone was asking, why did you add the 47? 47 is the cash proceeds on disposal of the subsidiary. If you check that note number, it is 3 or 4. The amount at which we dispose subsidiary. You know, these books, the ones we are dealing with, they are not consolidated. So they are individual financial statements. So it means the 47 in consolidation does not mean factored for. I hope that is clear. So 47 is the amount we receive on disposal. Kindly confirm you are okay with that. That is the same. Good. So 13,275. Non-controlling interest. Non-controlling interest. Working 2. What did we get? For these noise makers, we got how much? How much? $24.75. So give me the total of equity. Total of equity will be how much? 30, Mercy? 3750. Susan, 3750. Good. Non-current liabilities, we just add 85 plus 6. So 85 plus 6 should be 14.5. Are we there? Current liabilities, 47.75, 17.25. There is no adjustment. How much is that? That is 6 something. 6 what? 6 for current liabilities, 6,500. So total equity and liabilities. Confirm whether it is balancing with our total assets. Balanced. So that is 51,750. So who has a question? So the max was any 6 at 2. It should be any 6 at 2 for those 12 months. Any 6 at 2 will work. Thank you. So that is it. That is it. That is it. November 2020, question 2b. So November 2020. Page 56. So my students are there, allow me to read. H Limited is the parent entity of a group of companies with the 2 subsidiaries, S and R. Both subsidiaries have been owned for a number of years. So it means none was acquired within this year. A number of years means none in this year. So the following statement of profit was also fine, 30th April 2020. So ukishaona hiyo unaweza chora immediately. Ndio ukisonga, you see what happens. So it ends on 30th April 2020. This should start, check tomorrow. It will start on 1st May 2020. 2019, where? 2019. Good. Found it? So as you guys is able to see there, additional information, which is very long. On 1st May 2017, H Limited acquired 75% of S, a public limited entity. The purchase consideration was cash of 560, and the fair value of the identifiable net assets of S was 400. The fair value of non-controlling interest in S at the date of acquisition was 240. H Limited wishes to use the full goodwill method for all acquisitions. So, for all acquisitions, the ordinary share capital and retained earnings of S at the acquisition date were shillings 100 million and 200 million respectively. And there were no other reserves. The excess of the fair value of the identifiable net assets at acquisition is due to an increase in fair value of plant, which is depreciated on straight line basis and our 5-year useful life. So tutaongeza those net assets, then we compare with the net asset we have been given up there. The difference is that fair value uplift or revaluation. H Limited acquired 80% of R in 2016. Example. The purchase consideration was 600. R Limited identified net assets at a fair value of 550, which was equal to their carrying amount. The non-controlling interest had a fair value of 150 at the acquisition date. Fine, no problem. On 1st November 2019, 1st November 2019, hapo katikati, story inakuja, H disposed of 30% of the ordinary shares of R for a consideration of 375. R Limited's identifiable net assets was 675, and the non-controlling interest of R had a carrying value of 175 million at the date of disposal. The remaining equity interest in R held by H had a fair value of 575. After disposal, H Limited would exercise joint control over R. You know R, they were having 80%. They have disposed of 30, so they are remaining with 50. So 50 is joint. The profit and losses are deemed to accrue evenly, so no problem. Before I go to note 4, we bring it here. Somewhere here. On 1st November 2019, R disposed. All of them were quite a long time ago, but R was disposed that date. So R got a one. S is equals to full year subsidiary. R is how many months subsidiary? From the beginning up to here. How many months are those? Begin, just begin, not the months to include and the ones you're not supposed to include. From here to here. How many months are those? Dennis, hebu leo nihesabie vizuri. Irene 6, 6, 6, 6, 6, 6. Mercy 5. Mercy unaona 5 mahali. 6, yes. So May, June, July, August, September, October. 6 months. November is not included because first, it means November not included. May is included because it was first. So those are 6 months. So R is equals to 6 months subsidiary 6 months JV. Have that analysis. Very important for us. 6 months subsidiary, 6 months joint ventures. Good. Let's proceed. Kindly. Note number 4. H Limited sold inventory to both S and R at a price of 140 and 45 respectively in the month of October 2019. Okay. H Limited sold goods at a gross profit of 20% to group companies and third parties. At the year end, half of the inventory sold to S remained unsold, but the entire inventory sold to R had been transferred to third parties. So for R, there is no unrealized profit. So UPI, they have said half of inventory sold to S. So to S, inventory was 150. Then profit margin, they have said 20%. 20%. The ones which were sold to R, we don't bother. All of them were sold to third parties. So how much is the unrealized profit? They have said a half. So we have sold 150. So half of this is 75. 20% of 75 will give us a unrealized profit of how much? 15. Now you pay in better we got 15 for reasons which we don't know. So Susan gets 15. Somebody has not confirmed the same. Good. Confirmed by many. Note number 6. Goodwill arising on acquisition has been tested for impairment annually. And as of 30th April 2019, goodwill on acquisition of S. 30th April 2019. 30th April. Oh, by the beginning. 30th April is beginning here. Goodwill acquisition of S had been reduced in value by 15%. And on 30th April 2020, at the close, had lost a further 5% of the original value. No impairment had occurred in respect of goodwill acquisition of R. Fine. Required. Gain or loss arising on disposal of R to be presented on the consolidated statement of profit or loss, then consolidated statement of profits or loss. Allow me to calculate goodwill first. Let's calculate goodwill. So goodwill, I want us to get goodwill on acquisition. Goodwill on acquisition. So I want us to calculate goodwill on acquisition of both S and R. Of both S and R. I want us to do for both S and R. So we have S Limited and R Limited. Why am I calculating goodwill? It will be relevant when getting the gain or loss. So that is why I need to have my goodwill. For purchase consideration, so here we did not have balance sheet. If you have the balance sheet, go to non-current assets and check those investments. Here we did not have the balance sheet, so just trace where they were acquired. The example will communicate. So check the acquisitions. For note 1, how much do I bring? How much for S? How much for S? How much for S? Someone? Irene, 560, Brandy 560. The purchase consideration was cash of 560. Then R acquisition was in note 2. So purchase consideration, if you check note 2, you will see 600. Note 2, you see 600. Then you add fair value of NCI. Fair value of NCI. Fair value of NCI. Okay, now use which notes? We are going to note number. There's a lot of stories here. We are going to note number which one? Somebody, me, I'm tired of checking. Which note do we check for minority? NCIs and fair values. I saw it somewhere, but I don't even remember where it was. Where? Note 1. So note 1, the purchase, 560. The fair value of non-controlling interests in S at the date of acquisition was 240. So this one was 240. Labda kila moja iko na yake. Check note 2, the last bit of note 2. The non-controlling interest in R at a fair value of 150. So this one is 800. This one is 750. Less net assets. Net assets acquired or on acquisition, whichever. Net assets on acquisition. If you check note 1, they say, and the fair value of the identifiable net assets of S was 400. So S was 400. Then R, check note 2. The identifiable net assets at a fair value of 550. So this one at a fair value of 550. So goodwill on acquisition. Goodwill on acquisition. Goodwill on acquisition. This is 400. While this one is 200. So our next issue is on impairments. Next issue is on impairment. Next issue is on impairment. Is on impairment. So let's check impairment in note number 5. Goodwill arising on acquisition has been tested for impairment annually. Okay. And as of 30th April 2019, even last year, goodwill on acquisition of S had been reduced in value by 15%. So that is accumulated. So say let accumulated impairment. Accumulated impairment. But the other side, they have said no impairment occurred in respect of R. So funga R. Just close R. There is no impairment for R. Good if the one which is impaired is this one. So why am I calling it accumulated? Accumulated means in the prior years before this financial year. So in those prior years, they are saying 15%. So 15% of 400. What is 15% of 400? 15% of 400 is likely to give us how much? 60. 50. So the balance of goodwill will be 340. Continue the story. And as at 30th April 2020, now this year, had lost a further 5% of the original value. So again, less impairment. Impairment for the year. Impairment for the year, 5%. So they are saying 5% of the original. So 5% of 400. 5% of 400 of the original value. So not of the balance, but of the original. So what is 5% of 400? 20. So this is what goes to P&L. Admin. You take it to administrative. This is what you take to administrative. So net goodwill to CSFP balance sheet, you will take 320. If at all balance sheet is required, you take 320. But in the P&L, you take this 20. Accumulated will not affect, it can only affect the retained earnings brought down. Retained earnings brought down is what is affected with the accumulated impairment. So, to me, that analysis is so good, but there's something I really want us to determine before things get thick and thin here. Let's go to paragraph 2. Sorry, paragraph 2 of note 1. Let's check paragraph 2. Paragraph 2 of note 1. Paragraph 2 of note 1. Paragraph 2 of note 1. So I believe you are there. Paragraph 2 of note 1, they said, the ordinary share capital and retained earnings of S as at the date were 100 and 200 million respectively. And there were no other reserves. So it means those were the only net assets, those two. The share capital 100, retained earnings 200. The excess of the fair value of the identifiable net assets at acquisition is due to increase in fair value of the plan. So net assets, and they can also change net assets of S Limited on acquisition. On acquisition. Net assets of S Limited on acquisition. So ordinary share capital 100. Retained earnings, they have said 200. So it means we are talking of 300. Skip one line, reported net assets. The ones they reported, if you check note 1 up there, they reported this figure. They said it was 400, this one. So they reported 400 instead of 3. So the examiner says this difference is the fair value uplift, which is revaluation, balancing figure. So there was revaluation of 100. Evaluation of 100. So depreciation will be 100. It had a useful life of 5 years. So there is depreciation of 20 per annum. There is depreciation of 20 per annum. Very necessary for us. Good. So with that, allow me to answer on one of that question. Let me answer the question. So Roman 1, check well the gain. They want to gain where? Gain or loss arising on R to be represented in the consolidated statement of profit. Consolidated. So gain stroke loss to consolidated profit stroke loss. So to consolidated. So for consolidated, this is what you do. You check disposal proceeds. You check disposal proceeds. So disposal proceeds Go happy. Check note 3. Let's go to note 3, please. On 1st November 2019, H disposed 30% of R for a consideration of 375. 375. So check fair value of interest retained. So fair value of retained interest. What you are retaining back, you have to top up. So you continue reading. R limited net assets was 675 and non-controlling interest 175 at the date of disposal. The remaining equity interest in R held by H at a fair value of 575. What remains is 575. So you add with what you have received. So the total is like 950. Then you'll come here and say less net assets disposed. So net assets disposed in the same note, they have clearly said net assets was 675 less goodwill disposed. Goodwill disposed. Goodwill we calculated. We calculated goodwill of R. I deleted the figure. How much was the goodwill for R? 200. So we got 200. The only thing which makes this to be a little bit different with that other one, in that note 3 they have said, on the same date, check where 675 is in that note 3. R limited identifiable net assets was 675. Okay. And the non-controlling interest of R had a carrying amount of 175. So this net assets, there's a book value of minority. So you will less NCI on disposal. So on disposal of these net assets, of the net assets of 675, minority were claiming a book value of 175. So we subtracted from this 675. I would have done it before, but there is no problem. It's all the same. So here we are dealing with that figure which goes to the parent. So this plus this minus 175. How much do you get? How much do you get? You get 700. You get 700. Therefore, gain on disposal is 250. So that is it. That is it. Unless you have an issue. So let's check how consolidation will be. Both, I prefer us checking both P&L and the statement of financial position, the two of them. So even if we don't know what is going to be required, that is the best approach. So P&L will be H plus S plus R 6 over 12. R 6 over 12. Then CSFP will be H plus S only, if at all the balance sheet is required. At the end of the year, it has become a joint venture, so we don't consolidate for that. So that's how it should be done. Hizo zingine zote zimebaki hapo sasa ni madoido tu. They are all about madoidos. So we want to do presentation. Let me ask the class, can we present that up to the latest we can finish that, meaning we'll have done 2 good questions. The latest we can do that, we can finish that is 9:30. Can that be appropriate? I know we are on time actually, but no issue. Majority will take the day. Mass, yes, yes. Yes, majority says yes. So let's do presentation. Then tomorrow we do our third illustration. I promised on this we have to do 3. So we start today, we have done 1. If we finish this, those are 2 questions. Then tomorrow we do 1 to wind up the disposal. So there being no concern, have there H group. No, write up will waste my space. So write what is required. H group, consolidated statement of profit or loss. Those stories there. So that to avoid wasting more time, we go to presentation. I believe you are ready. I believe you are ready, you are ready, you are ready. So we kick off. So we stick to theirs. So it is HSR 6 months. So revenue 42. So please, I beg you be giving me the answers promptly so that we finish fast. 42.75 plus 25.15 plus 17.30 times 6 over 12 minus intergroup sales. Minus intergroup sales. So intergroup sales, you subtract for both. There were 2 of them, so you will have to subtract whatever they sold internally. That was mentioned in note number 4, the 150 and the 45. So there is 150 and there is 45, like that. So give me that figure. So the one will be apportioned in 6 over 12. You can be taking a half. 1730 divided by 2 plus this minus those ones there. What will you get? Someone with a figure there? Someone with a figure? Massey 7460. Someone to confirm? 7460. Confirmed by someone there? So someone can be giving, someone confirms. Yes, Susan has confirmed. Let's go to cost of sales. So cost of sales, 2735 plus 1445 plus 1010, 612 minus, again, minus the 2, then you add unrealized profits. So minus 150 minus 45 plus UPI. How much was the UPI from your end? How much was UPI from your end? 15. 15 plus depreciation. There was depreciation every year. We are supposed to charge depreciation at 20. So you bring here depreciation 20. Like that. So 20 is an annual depreciation. So adjust and give me a figure. Someone with a figure? 4525, Susan. Someone confirm. 4525. So gross profit is how much? Gross profit will be how much? 2935. Then there was gain on disposal, R limited. We have just gained how much? The gain was 250 or 150. There is a gain we have just determined up there. The gain on disposal should be credited there, 250. So this is 250. Then there is a joint venture for share of PAT in JV, in joint venture. Joint venture and associates, we only take profit after taxation, profit after tax. That is what we take. So you take 50%, times 50% times. Can you check profit after tax? So check the question. I want to see what you are seeing. What are you seeing? Profit after tax. Check P&L. In the P&L, profit after tax in R. It is how much? 380. I've also seen 380, but only for 6 months. It was a joint venture. There's a light effect there. Let me do something only for that space. It was only a joint venture. It was only a joint venture for 6 months. So that will be how much? Half of this is 190. 190, 95. Confirm? Is that 95? 95. We proceed. Right. We proceed. Distribution cost. So distribution will be 305 plus 195 plus 90, 6/12. Give me that figure. Give me that figure. $545. Remember to subtract. Then admin, you add 370 plus 235 plus 120, 6/12, plus impairment. Impairment for the year is classified as administrative. This one, there is this impairment for the year. It was 20. So bring here 20. Please make sure you indicate where 20 is coming from. That is impairment. Tell me that figure. $685. $685. So from the arrangement, that is operating profits. So operating profits. So what do you get from 29 and just pack up? Someone is getting 2050. Then finance cost. Finance cost is 45 plus 40 plus 30. This is a half. 15 plus this 60, 100. Okay, 1950. I hope that is true for the profit before tax. Then income tax. Income tax 160 plus 120, 106. This is 280. That should be 330. Here you see VAT. No, I can know if I want. This is 1620. So, please confirm 2050. Oh, yeah. 1620. Confirm if that is okay. Then I proceed. So confirm. So profit after tax is 1620. Then other comprehensive. Other comprehensive income. So other comprehensive income, we have revaluation gain 150 plus 80. This is 230. So total comprehensive income will be 1850. And now we want to share. What are we sharing? You share the PAT and this total. These two, we share the two, the PAT and total comprehensive. So come here and say PAT to NCI holding company. So the PAT, which we are going to share the 1620. Then total comprehensive to NCI holding company. Also, we are going to share 1850. And that will be the end of it. Have that. That will be the end. Hi. So as you see, our time is limited. So NCI for PAT, I told you and I will repeat, they only take profit after tax in the subsidiary. So you come here and say NCI's profit, PAT, NCI's PAT in S and R. So reported. So reported PAT, those two entities. You pick them as per the question. We are going to share. So reported, you can see here for 80, you can see here 380, but 380 for 6 months, 190. 380, 6 over 12. Show in brackets. 380 times 6 over 12, so 190. Less impairment. Impairment was 20. I'm subtracting because it was full method. NCI participated in goodwill calculation. If it was partial, then you don't. Less depreciation, 20. I will not subtract UPI because S never sold goods. Goods were sold by head, so their profit was not affected. So adjusted is for 40, adjusted is 190. Have those figures. Have those figures. Therefore, NPI will be in S, S parent was having 75, minority 25. This side 20. Parent was having 80. In R, before disposal, for the first 6 months, it was 80, so minority 20. 75, minority 25. So this one should be 110 because 25 is a quarter. So 110. What is 20% of 190? 20% of 190, 38. So total going to the minority, total profit to minority, 148. So to minority, 148. So bring here 148, 148. So the parent will take 1620 minus 148. So the parent goes with how much? $14.72. $14.72. Good. Let's go to comprehensive. How did you get this total? You took PAT plus revaluation. The same thing applies here. You take what someone, so someone here I'm implying to NCI and parents, what someone has gotten in PAT plus what they should get in revaluation. So in PAT, NCI Omepata 148. They have gotten 148. Here, revaluation, which they will share, is not the total. They share this one, the one in the subsidiary 80. And the 80 was in S. So in S, they will take 25% of that 80. So they don't go to the revaluation in the parent. They only take revaluation in the subsidiary. So they take 25% of the 80. Add for me the total. Total will be how much for NCI there? For NCI's total will be how much? 168. So this is 168. Parent will take 1850 minus 168. So parent goes with 1682. 82 or 32? 82. 1682. 82. And we are done with that question. We are done. We are perfectly done with that particular question. So when we meet tomorrow, let's start exactly 7:15, because kuna swali lazima tufanye. It's a very comprehensive question. Even I don't think if we can finish it within 2 hours, unless we extend like the way we have done today. Right there, May 2016. May 2016, question 1. May 2016. May 2016, question 1. May 2016, question 1. A review. So check that question. It's the question we are doing tomorrow. May 2016, question 1. Review. Is our timing still okay? Is our timing still okay for the majority? That is the 7:15 issue. It is still okay for the majority. You know, you must always carry out review. So for Lawrence, yeye anasema yeye ako sawa. Philip, yeye anasema yeye ako sawa. Hussein, Abdi, Halima, Brenda, Brandy, Barbara, Boniface. What comments do you, I think is still working. Jonathan, Dennis, Kennedy, Monica, Mercy, Susan, Noah. The timing. How is the timing? Irene? Let me read for Hussein kidogo too. Hussein kidogo before. I think everyone is okay. Hussein, ulisema? No, we are commenting on timing. Is the timing still okay? The 7:15, Hussein, that is what I was trying to do a review. It was naumia silently, but I can see everyone is okay. It works. So let's meet 7:15 tomorrow for that question. In fact, I'm feeling so happy because we have at least managed 2 questions on that. So that would mark the end of, not the end of group, the end of disposal, that question. I was at liberty to move to the next with those 2 questions, but remember, disposal is one of the key areas being checked this semester. So I'll have to do those 3. So once I'm done with this, I'll be comfortable. Otherwise, do have a good night. Let's meet tomorrow. Same place, same time, same people. Thank you.